After grinding lower, the stock market rebounded this summer. Have we seen the worst of it? Has the market bottomed? I personally don't think so. I'll explain that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Has the market bottomed yet? Now, we saw, obviously, from really the beginning of the year, from the second trading day of the year up until the summer, the market was just grinding lower. We had a couple of relief rallies, but they didn't last long, and they weren't that big, okay? So this summer, when the market finally rebounded off of some really low extreme points in June, does that mean we've seen the worst of it? Has the market bottomed and we're on the other side of this? Well, I'm going to peer into what previous bear markets can tell us about maybe what we're going through. But let me just tell you also from experience, you can't tell that the market has officially bottomed and we're on the other side of this for months, sometimes even a year. I know the most recent one, the COVID pandemic and economic shutdown, the recession and everything, you could tell pretty quickly. It was, a few months later, you're like, yeah, I'm pretty sure we've seen the worst. Like the worst is over, okay? We are in rebound. Now, at the time, I think I even had a video that came out right after the market rallied off of the low point and said, hey, do you think the market's bottomed? I doubt it. And sure enough, the Fed had thrown so much gas on the fire that, yeah, that was the bottom. We had the 50 best days in the stock market ever, the best 100 days in the stock market since the Great Depression. And so, yeah, it was pretty clear the market bottomed. Within a couple of months, we could say, yep, that was a bottom. That's not normal. That's not normal. That's why that was the best 50 days in the stock market ever and the best 100 days in the market since the Great Depression. Because normally, off of a bottom, there's still a lot of, head fakes, if you will. And therefore, months go by, and you're still wondering, well, wait a second, are we going to drop back down? Has this all been sort of a facade, a relief rally? You just can't tell. So here's the bad news I'm going to tell you, okay? The bad news is that during bear markets, during significant stock market declines, bear market rallies or relief rallies or surges in the midst of a still confirmed downward trend, that's normal. That's not a unique experience. That is a feature of declining markets, these relief rallies. Take a look at what history shows us here. Yeah, we've had during this decline, which basically started in December, around the beginning of the year, we had a 6.1% advance in early February. We had an 11% advance during the springtime. Then it went straight down. We had a very, very brief advance in May. And then we've seen this rally at the time I'm recording this, end of August, this rally at from the midpoint, second half of June, okay? This is normal. Compare that to the left side here where we're looking back at bear markets going back 50 years, okay? The number of relief rallies, 8, 4, 7, 7. Guys, this is normal. This is normal. The times that we haven't had any relief rallies were times when it was a flash crash and then a very quick surge thereafter. And Black Monday, so 1987, that was part of it. It was also in response to some Fed moves, by the way, and the market got really, really ahead of itself and then reacted strongly when the Fed pivoted and during the COVID recession, right? So we didn't have any relief rallies in because they were a flash crash. No one wants to revisit either of those time periods again ever, right? The market dropping over 20% in a day. Yeah, no thanks. I never want to do that ever again. And therefore, those, I would argue, are anomalies to this relief rally concept during a bear market. Here's the scary thing, guys. If you look on average, the largest rally during a confirmed downturn, 17%. Wouldn't you argue that a 17% rally is an emerging new trend? No, actually, experience and history tells us that's not the case. A rebound of 17% on average, guys, could be more than that. And certainly, in order for an average to be an average, there are times when it's more than that. You're going to have a relief rally of that and more still during a downtrend. So guys, Feelings lie. Feelings lie, especially as an investor. What's my feelings? What are my hunches? My hunch is that we have not seen the bottom yet. And I hope I'm wrong, okay? I hope I'm wrong. But here's the reason why. I did a video a couple months ago about here's what would happen in order for the market to bottom right now. There's so much pessimism and sort of what's at play causing the market to be grinding lower. Here's what would need to change in order for the market to bottom. I would refer back to that because my thinking, even though we had this summer relief rally, my thinking, hasn't changed much. Number one, I still think we're in the early stages of an economic slowdown. If the market has bottomed from here, it's because we actually didn't see an economic slowdown. It was all just inflation and supply chain labor shortages. It was all that, and there was no economic slowdown that was accompanying it, and we'll have that in the future. So it's sort of if we have seen a bottom, it means it's delayed, right? There's more economic pain ahead at some point in the future. My hunch is that we are going to see an economic slowdown because of the inflation and all the supply chain, all these other things. And so we're just still on the early stages of that. Yes, this job market is still so strong. How could we possibly see a declining and big contraction? Well, maybe we're just working through that right now. That's my hunch. That's number one. Number two, the Fed hasn't been mean enough yet. In my opinion, don't fight the Fed. The Fed is still in the process of being mean. I don't think we're seeing a Fed pivot here where all of a sudden they're going to start accommodating again. They've still been accommodating, and we've been seeing inflation. So they haven't gotten mean enough yet. Therefore, don't fight the Fed. The Fed is still tightening, and therefore I would assume, I don't know if we've seen the worst of this in the stock market. Next, typically, bear markets bottom when people are just done with stocks. They're just fed up. There's no meme stocks anymore. People are no longer kind of playing the market. It's just down to these exhausted, tired, long-term investors because all of the day traders or a lot of the speculators have just sort of been snuffed out because the market pain has been so severe. We haven't seen that yet. Not even close. One of the interesting things about the summer relief rally was that meme stocks came back and with a vengeance. And so I think likely we see a bottom or the right bottom when a lot of that pain is realized and a lot of that speculation, those speculators move on to other things. And then finally, one of the things that I would argue is just the hallmark of this current economic challenge and stock market challenge is inflation. And we haven't solved it yet. I think the Fed is just expecting inflation will solve itself. And I'm not so sure that can happen. And so there again, I would imagine we might not see a bottom in the stock market until we have a confirmed, yes, we've addressed inflation, we've solved inflation, we believe. So I hope I'm wrong. I truly do. I believe in the markets. I'm not a day trader. I'm not a speculator. I believe in the long-term functioning of the markets. I just look at history and would not be surprised if the market hasn't bottomed here. But here's the thing. What's the takeaway for you? You shouldn't have an investment strategy that's hot and cold. You should have an investment strategy that you're employing that is designed to help you navigate great times and bad times. It shouldn't, if your investment strategy is left up to, when the economic winds change, you've got to grab the wheel and make a big adjustment, I would argue that's not an appropriate and prudent investment strategy, unless you're a trader. If you're a trader, that's very appropriate. But if you're a long-term investor, no, your investment strategy that you're using should be designed to work in good times and in bad times. So diversified, but you've got some momentum, you've got some other strategies built in there to manage down times, okay? That's the first thing. Second thing, those investment strategies and the risk that you're taking needs to be connected to your overall financial plan. Because if you're taking the right strategies and you diversified and all that sort of stuff, but you're extremely low risk and you're age 30, that's not connected to your financial plan. Or if you're taking extreme risk and you're going to retire next year and need to start living off of this money, I would say that's disconnected from your overall financial plan. And third, that's sort of the final thing that I would share is what if I'm wrong, and what if the market has bottomed and things kind of emerge and surge from here? I saw a report JP Morgan expects stock market will be back at all-time highs by the end of the year. Gosh, I hope so. If that is the case, I think there's more economic pain that we still have to churn through at some point. And so I would expect that the stock market might not, maybe it's recovered from this, but it might not have a ton of upside potential for another year or 2 years or so. So to me, the third takeaway from this is, when do you need to start drawing on your investments? Or are you already at that stage? And if so, those dollars, make sure that you're what we call a personal pension plan. Make sure you're employing a personal pension plan where the dollars that you need in the next 2 to 3 years are in low risk. The dollars you need in the 5 to 7 years after that are in medium risk or income investments, which thankfully there's some income being paid right now. It's the dollars that you won't need for 10 plus years that are the ones that are taking the most risk. And so that'd be the third takeaway that I would have for you. Whether or not I'm right and we go on to see, things get worse before they get better, or I'm wrong and things do rebound from here, that is prudent to take those 3 steps and apply them with your CFP. If you don't have a CFP on your team that can help you with these investment decisions, make sure it's connected with your overall financial plan. You can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.